Hi, I'm James Dunn. Welcome to the Inside Network. Welcome to INDepth, where my guest is Scott Bennett, Head of Quantitative Research and Client Solutions, Australia-New Zealand, for Northern Trust Asset Management. Welcome, Scott.
Thanks, James. Pleasure to be here.
And the topic we're discussing is factor investing in Australian equities. Now, Scott, factor investing in global equities is a well-known concept, a well-trodden path by many asset owners, but factor investing in Australian equities hasn't been as prominent. It's gaining traction slowly. The adoption isn't really at the global equities level yet. Is that a fair assessment?
Yeah, I think you're right. So when we look at global equities, there's been a large adoption of factor-based strategies. So when we look globally, there's about $1 trillion that is invested in systematic factor-based investing at the moment. When we break that down to Australian equities, we don't see as large a take-up. And that's largely because it's a fairly new concept for the Australian equity market. So what we've been doing a lot of research on is making sure that when we bring factor-based strategies to the Australian equity market, that they're specifically built for purpose and allow investors to gain that global equity premium within the Australian equity market.
Do the factors exhibit the same characteristics in the Australian stock market as would be expected from any other stock market around the world?
By and large, we do find that the factor premium or the factor returns are very similar in Australia to what we see in terms of global equities. So the relationships between the factors is the same and the underlying return drivers are the same. What we do find though is that the Australian market does have some nuances which need to be managed that we don't find in global equities or even US equities for that matter.
Run us through the key factors, the main ones in the palette.
Yeah, so really when we look at return drivers for equity markets, there's 4 key factors. Value, so that's buying those companies that are trading relatively cheap versus the market or their peer group. There's momentum, which is really identifying those securities that have done relatively better than the market and will likely persist going forward. The third one is quality, and that's identifying those companies that actually manage shareholder capital better than other companies. And fourth and finally is low volatility, and this notion that by holding companies with a more stable return profile, over time you get the benefits of compounding.
So what's been holding back the full adoption of the factor approach in Australia? What are some of the concerns that investors have in this market that you've encountered?
Yeah, so I think the biggest concern is a lot of the research that we see when it comes to factor-based investing is really coming out of the United States, and it's focused largely on US equities and global equities. But when we look at the construct or the microstructure of the Australian equity market, it's quite different to what we see in global equities and also US equities. It's much more concentrated. It has very heavy sector biases, and also we're much more volatile in terms of the exposure to small caps as well. So these are 3 key areas that we think need to be managed by investors to ensure that they're able to actually get the return premium without taking on excessive amounts of risk.
What are the crucial considerations when building a factor strategy for a single asset class like Australian equities?
Yeah, so concentration is a really key one. So when we look at research on factor-based strategies, they're usually done on broad-based equity markets such as the US or global equities. But when we come to look at markets like Australia, they're heavily concentrated. In fact, the Australian equity market is one of the most concentrated equity markets in the world. It's almost 10 times more concentrated than the global equity market. So this concentration has significant impacts in terms of active risk and active share levels, and that needs to be managed specifically when building a factor-based strategy. The second one, as I mentioned before, we're a market that's dominated by 2 key sectors, financials and materials, and the underlying drivers and the accounting of financials and material stocks is vastly different. Investors need to be specifically accounting for those differences when they're building out the factor profiles. And the final element is risk, and specifically when we look at exposure to small cap stocks, making sure that we're not overly exposed to small cap equity risk, which can actually dilute some of the returns that we would expect from the factor premium themselves.
Portfolio construction plays an absolutely crucial role in creating any strategy. It's never more important than when considering singular market strategies. So what was Northern Trust Asset Management's approach in putting together that factor approach for Australian equities?
Yeah, it really comes down to three key things. So one is how we design the factor. The first one is making sure that we take a multi-dimensional approach. So using multiple metrics, whether that's for value, momentum, or quality, to ensure that we're getting good breadth of coverage and getting higher conviction in those underlying factor characteristics. And the second component is really key, is being sector neutral in terms of how we build our portfolio. So when we're building those portfolios, we're managing our sector exposure, and then we're also managing our exposure to other risks such as size, as I mentioned before. And then finally, the other one, which is extremely key, is making sure that we're sector relative in terms of how we rank and score companies on particular factors. And that sector relative approach is extremely key. So that means that we're not comparing a bank, for example, with a resource company. We're looking for value within financials, we're looking for value within resource.
Before we tackle the how, let's address the why. Why should asset owners consider using a systematic strategy in their Australian equities allocation?
Yeah, we see really three key reasons why institutional asset owners would consider a factor-based strategy for their Australian equity portfolio. The first one is effectively risk management. So actually building a risk-controlled portfolio that can provide more stable returns through time. The second component is transparency. So we're operating in a market environment where underlying investors are increasingly asking for more transparency in their portfolios, and by being systematic and having a rules-based approach, it's very clear to understand what's in the portfolio and why it's there. And then finally, the third one is cost. In a highly competitive market, ensuring that we can keep those costs low while maintaining those excess returns is really key for investors, especially as we enter your super, your future world.
Portfolio construction obviously plays an important role when creating any strategy. What was Northern Trust Asset Management's approach to portfolio construction when developing its factor capabilities in Australian equities?
Yeah, you're right. Portfolio construction is key, and it's absolutely critical when you're dealing with a concentrated market like Australia, because you can identify the right factors, but if your portfolio construction is not appropriate, the active risk that you take on or the residual risk can actually swamp the returns that you would get. So our research has showed that actually to be effective within Australian equities, you really need to manage your active risk budget and your active share budget. That way, the factors we're targeting what get represented in the underlying returns. And what we've found is that when you take traditional approaches to portfolio construction, whether that's equal weighting or capitalisation weighting, those size exposures really dominated and diluted a lot of those factor returns that we were targeting. So our approach really focused on building a robust optimisation process that looked at controlling for things like sectors, controlling for things like size and liquidity, and ensuring that those targeted factors were effectively what we were representing in our portfolio returns.
How do you see clients adopting these systematic strategies in Australian equities going forward?
We see clients utilising these strategies on a multitude of levels. So we have clients that have largely passive or market cap-like exposures that are really looking for an incremental improvement in their return without necessarily increasing their underlying cost base. And so for a lot of investors that are passively focused, they're looking for ways that they can incrementally improve their return without taking on a lot more risk. And then we have other clients who are much more of an active portfolio, and where they see factor strategies being a great complement for their portfolios and their broader funds is effectively by maintaining that exposure to return drivers at a much lower cost and much greater transparency and consistency. So we see systematic strategies really falling right in between what would be classified as traditionally passive or traditionally active portfolios.
So does it give them a third way?
That's right, it really is. It's the third leg of the stool almost, if you think about portfolio construction. So effectively, a lot of investors have used a combination of active and passive when building their portfolios, and this really allows them to actually encapsulate a lot of that transparency that they get from passive portfolios, but also the return improvements they get from active portfolios.
How do your clients use this strategy when they're actually putting it in place? What roles do they assign it?
Yeah, it's a really good question. And what we see is, depending on the investor, they're using factors for a multitude of purposes within their portfolio. So they could be actually looking to complement a passive allocation and effectively dial up their risk a little bit without introducing too much active risk into the portfolio. Or they could actually be using it to complement their existing active managers within that portfolio as a way of maintaining that return profile while paying lower fees. So we're actually seeing a large amount of appetite from both people with large passive allocations and also large active allocations. It really sits within the middle between, say, a fully passive strategy and a fully active strategy.
Thanks, Scott. Thanks for your time.
Thanks, James. Pleasure.